Welcome to the Crop Insurance Podcast. I'm Mike Rydell, a third-generation crop insurance agent here to make federal crop insurance less confusing and more useful. Whether you're a seasoned grower or just getting started, we're here to help you stay covered and confident in every season. Today's episode is brought to you by the Crop West Insurance Group, your agent-friendly crop insurance group. If you want more support, smarter marketing, and better tools to help grow your agency, Crop West's expert team has your back. Visit cropwestinsurance.com to level up today. Crop West Insurance is an equal opportunity provider and employer. Welcome to the Crop Insurance Podcast. I'm your host, Mike Rydell. Today we have a very special guest, Jaime Cortes, who's an expert in PRF, Pasture, Rangeland, Forage. Now, if you listen to this podcast or you're new to this podcast, make sure you go back to our previous seasons where we talk about the PRF program in more detail and on a more granular level. Today, we're using this opportunity to deepen your knowledge on the program, to learn more about how this outstanding PRF program can work for you in your operation. As we mentioned, today's special guest is Jaime Cortes. Jaime is a sales executive with the Marsh McLennan Agency and is from Moxie, Washington, right in the heart of the Yakima Valley. Jaime is a former educator turned crop insurance pro with a background that includes 11 years in education and a master's in organizational leadership. Since entering the insurance world in 2021, Jaime has focused on working with tribes and Native American producers across the Pacific Northwest. His dedication and outreach were nationally recognized in 2024 when he received the NCIS Outstanding Outreach Award. When he's not helping producers solve problems and protect their operations, Jaime's spending time with his wife Crystal and their 3 children, Aria, Ezra, and Adley. Welcome to the show, Jaime. Why don't you take a minute to tell us a little bit more about yourself?
All right. Well, thanks, Mike. I appreciate you inviting me on the podcast. I've got to know you these last couple of years with Crop West, and so this has been a great, I think, relationship building, knowledge building, educational for me. So I appreciate you inviting me. As you mentioned, I grew up in Toppenish, Washington, in the Yakima Valley, so predominantly Hispanic, large agriculture area, Heritage University, my background there with education. There's 2 things that I think align with me is the ag industry and then education, right? And so that's kind of what I've been focusing on since getting licensed in P&C and crop. These last 3 years, I have been focusing on Native American organizations, connecting with those groups, underserved populations, and it's been very, very rewarding. And it's through those partnerships that I've been blessed to, work and speak across different states, presentations, and it's amazing, right? As you know, we get to work with great people. We get to help them figure out their problems with their crops, with their operations, and we're professional problem solvers. I'm gonna steal that from Gary Heilig, who I think we'll probably talk quite a bit about in Crop West. And so just excited to be here and share what I know about PRF and crop insurance, because it's a great program. So thanks for having me.
Before we dive into PRF, really briefly discuss the Crop West Insurance Group and kind of what that means to be a part of that group, how it helps you as an agent, not just financially, but in terms of industry expertise and knowledge. And so what does being a member of the Crop West Insurance Group mean to you?
For me, it's invaluable because we get to partner with one of the smartest people I know, most knowledgeable people I know in the crop insurance industry. But we also get to meet folks like you, Mike, from around not just Pacific Northwest, but other states, right? So Crop West has multiple agents across multiple states, and because of Gary and who he is and what he knows and his knowledge and experience, I mean, he's picking, I think, kind of the best of the best, if you will, in my opinion. And so, being a part of that is invaluable. And then having the ability to talk with, partner with, build relationships with the approved insurance providers, or AIPs as we call them, is also um, amazing, right? Because AIPs matter, right? The relationships matter, and so having that partnership with Crop West and the AIPs is invaluable.
Okay, so now we're going to jump into breaking down the PRF, or Pasture Rangeland Forage Insurance Program. Just a very high level explanation, and then we'll have Jaime break it down even further. So, PRF is a federal crop insurance program. It's designed to help ranchers and hay producers protect against lack of rainfall. Now, PRF is an area based policy, meaning it doesn't cover individual fields. Instead, the coverage is based on a specific grid. Think of a grid as a square section of land, roughly 12 by 12 miles or 15 by 15 miles, that's set by the USDA. Everybody in that grid is treated the same, regardless of what happens on their individual acreage. Now, the program uses the rainfall index data from NOAA, the National Oceanic and Atmospheric Administration, and it compares actual precipitation within your grid to an historical average. You're going to select a coverage level, let's say 90%, and that becomes your trigger point. The average rainfall index data times your coverage level is your trigger point. If the rainfall drops below that threshold during your selected period or interval, then you would potentially collect a loss payment. Now, the interval is a 2-month time period, and these are chunks of time that you're insuring your average rainfall. Now, this would be like January to February or May to June, etc. Now, payments are based on how much rainfall occurred in those specific intervals, not necessarily the whole year. It's just your intervals. Now, it's not about how much hay you produce or cattle you graze. It's more about how much rain falls in your grid during your selected interval. That's pretty much PRF in a nutshell. It's a simple concept. It's an area-based coverage, and it's a smart tool for managing your risk during dry years. Now, Jaime, how would you help define PRF or help our listeners understand it a little further?
Yeah, Mike, you hit it spot on. I think to keep it very, very simple, because we can overcomplicate some things in crop insurance because it is complicated. But to keep it just basic level, you have a an index, right, in your grid. So the average index for that 70-year history that NOAA collects, they've got the data, so you have an index. And so we're basically trying to cover a specific coverage level between 70% and 90%. And what we like to do is have our producers at the 90% level, because you're more likely to trigger a claim at that level. And so we'll dive into that a little bit further. But so when your average rain drops below that 90% coverage level or trigger, then you are going to be in an indemnity situation, in a payment situation. And so um, it's our job to look at the data, to look at drought monitors and IRI, which is the which is Columbia University's climate prediction models. And so we look at that information, and we want to make sure that we put the producer in a situation where they are going to trigger a claim, right? Um, and we're not playing a game, but we are putting them in a situation where when there is lack of rainfall, we want them to be able to get paid for that. And the reason why is because there's different types of operations, right? There's a haying operation and a grazing operation. And one of the things that I think we didn't cover or we haven't mentioned yet, Mike, is that PRF is a rainfall index plan of insurance. It's an area plan, like you mentioned, but it's also the for apiculture, for your honey operations, your beekeepers, your pollinating services, right? So there's essentially PRF for hanging and grazing, and then there's apiculture for those beekeeping, pollination, honey operations. And so with PRF, we're looking at acres, right? Haying acres or grazing acres. With apiculture, we're looking at colonies. So, so we want to look at all that information and make sure that we are setting them up to ensure that they are getting, they're going to get an indemnity in the event there's lack of rainfall in that area during the months that they need it, right? So there's different strategies that we can go over. Um, but that's essentially it. We're putting you in a situation where you're going to trigger an indemnity if there's lack of rainfall for your operation because they need rain. Um, they need rain for their hay to grow. They need rain for their pasture because if they're going to have the cows out there or their bison or domesticated livestock, right, they need rain to produce that forage crop so that they can feed or grow their hay operation so that they can sell their hay, right? And if it doesn't rain, they're in a world of hurt. And so this is a great program to help supplement those losses.
The biggest misconception or things that people get tripped up on when it comes to crop insurance is the difference between an area plan and an individual plan. I'm sure you've seen it. So, can you kind of walk us through how or why somebody might misunderstand that concept and just what kind of surprises could that lead to?
Yeah, so area plan is a region, an area, right? So for PRF, you're looking at a grid, as you mentioned earlier, right? And I've heard 17 by 17 miles at the equator, but it is 0.25 latitude, 0.25 longitude. And so 17 by 17, I've heard 15 by 15, 12 by 12, but essentially it's an area and it's a square or rectangle. And so you're looking at that area. So that's the how rain index works, right? If there's lack of precipitation in that area where your acres are, you can be depending on the coverage level and intervals that we select and productivity factor, you can potentially trigger a claim. Versus your own operation, right? Like you mentioned actual production history, or they're looking at your individual operation, your yields, your production, and so those are different. Um, the beauty of PRF, or one of the beauties of it, is you can have a great hay crop and you can still trigger an indemnity, right? Because it is looking at the area. And I think that's also a misconception, right, for some producers. Like, well, I don't need it because I'm irrigated and I don't have any issues with my production. I've got good yields. I'm like, okay, great. However, input costs are still rising. You still have to pay, maybe some ranch hands, right? Or you still have to pay people to operate your business. You might have to move cattle. That's fuel, right? So you can still be an indemnity situation if there's lack of rainfall in your area. And so those are the conversations that we want to have and really drill down and and help them understand that just because your land or your crop is producing and it's doing well and that's great and we want that, but there's still input costs and this could help offset some of those. And the other thing, Mike, is that um, farmers don't just have hay, right? They might have some wheat, they might have some corn, they might have some soybeans, they might have some livestock, right? Of course. So this payment can also help with some of those other operational costs. And so it's a great way to supplement losses and input costs.
So it's really
Yeah,
important to understand that area risk.
right.
Now, we've spoken about intervals and we've mentioned intervals throughout the opening, and we've kind of continued to mention intervals. And I think one of the first things producers are going to ask is which interval's the best? Which one is the best? And how should a rancher, hay producer, or apiculture producer, how should they go about selecting those intervals? And then what's some of the mistakes you see people making when choosing which interval to insure?
Great question. So when selecting intervals, we always want to look at the data. So we like to run different scenarios. We like to look at a 20-year history, a 15-year history, 10-year history, 5-year history, and even, down to 2 and 3 years. Because we know that weather patterns from 20, 25 years ago, 50 years ago is different than it is today. So we want to look at that history to make sure when we get down to the less than 5 years that we're looking at for selecting intervals that it's in alignment, if you will. And so when selecting those intervals, we look at the average index, right? The rain index. And so remember, if we want to have a 90% coverage level, which is a 90% trigger. So if it drops below 90%, then you're going to be in an indemnity situation for that specific grid. When we elect the intervals, we like to be at 90% or below. So that means for a 10-year period or a 20-year period or a 5-year period, if we're at that 90% or below, that means the likelihood of those intervals that we selected is going to be under 90%. So we're going to more than likely trigger an indemnity. And so looking at the data, we look at the average index, we look at the years paid within that time frame. We look at the loss ratio for that specific interval or intervals. And loss ratio is basically the indemnity that you received in that time frame compared to your premium, right? So if a loss ratio is greater than 100%, that means the farmer benefited from that program, right? Or that plan. And so for every dollar you put in, you get $1 back if it was at 100%. And so I ran the numbers earlier today and just looking at loss ratios for PRF nationally, and we've been over 100% since 2017. And so, for example, last year, 2024, was 195%. So nationally, so for every dollar a farmer put in the PRF program, they get $1.95 back, right? So every state, county, every grid performs differently, but nationally, for the last 9 years, it's been well over 100%. So they're benefiting from that. So we look at years paid, we look at loss ratios, we look at the average index that we elected, and then from there we determine, well, when do you need it to rain? When do you take your hay to when do you harvest it, right? Or when do you take your cattle to market, right? So looking at asking those questions too, and figuring out what are the best intervals to select. You don't have to, there's multiple strategies. You can be aggressive, and aggressive or more targeted is selecting two-month intervals, right? So you're putting more of your eggs into two baskets, if you will, because you have to have a minimum of two intervals. If you want to be more of a conservative, have a more of a conservative approach, or spread your risk out, then you're going to select more intervals, right? And that's another strategy too. Um, but again, we are looking at years paid. We're looking at the index, the average index for those intervals that we elected, and we're also looking at the loss ratios to determine which intervals are the best for that specific farmer in that area.
That's very insightful on the intervals. And I know that's a lot of confusion for producers. But there is one thing that you've mentioned a couple times throughout that is a nice bonus or a nice feature of PRF, and that's the productivity factor. So, can you talk a little bit about what that productivity factor is and then how that can affect their bottom line?
Yeah, so and I listened to your podcast before on PRF, and so you hit it spot on, right? A productivity factor is given by RMA. So there's a value that RMA, Risk Management Agency, USDA, that they give a value to land, right? In this case, it's pasture or grazing land or hay land or even apiculture for your colonies. They give a value for those specific colonies or acres as it relates to your land, right? Your county, your state. So a productivity factor for PRF ranges from 60% all the way up to 150% in 1% increments. So for example, if your haying ground was valued at $10 an acre, according to RMA, we can go up to 150% of that. So $15 an acre, or we can go down to 60% of that or $6 an acre. So it's up to the producer, right? The producer knows kind of the value of what their land is. And so the producer can select anywhere from 60% up to 150% of that productivity factor to to help um, help identify kind of their risk and how much they want to insure in the program, right? So the productivity factor is there as a tool for you to use. If you don't want to go up to 150% or 100%, you can elect a little bit lower productivity factor, and that decreases the value, which is also going to decrease your premium, which helps, right? That's going to help you save some money, some dollars there in the premium. So our what we recommend is talking about coverage levels. We want to be at the 90% coverage level because you're closer to a loss, you're closer to a claim. But with the productivity factor, you can definitely change that up if you're concerned about premium, or if you're just trying to figure out the program and you want to start. Maybe we start with a lower productivity factor so you can get an idea of how it works, save you some premium dollars, and then you know let the year go by and see how it works, and then you can increase that productivity factor if you see fit and if that's within your budget and your goals for your operation. But essentially, you're right on. It gives you a value, a higher dollar value for your land, or even a lower dollar value between 60% and 150% of that.
And as you were talking about that, you mentioned kind of I don't want to say the last piece of the puzzle, but a pretty major piece of the puzzle is the cost. And yes, this program is subsidized, but you still have out of pocket expenses involving your crop insurance programs. And so, can you talk a little bit about kind of that balancing act and what affects the premium for PRF in regards to the farmer paid premium?
So there's a lot of things there. What affects the premium is one, the number of acres, right? So they give you a value per acre, and so the more acres you have, right, the more premium goes up. Productivity factor, right? If we have 1,000 acres or 100 acres, and you have a value of $10 per acre, you can do the math, right? So, but if we want to go up to 150% productivity factor, obviously my premium is going to increase as well. If I'm at the 90% coverage level, right, my premium is going to increase as well. So looking at how that can affect your premium is the coverage level, number of acres, and then obviously the value there and the productivity factor. So if you're concerned about premium, right, because it's a real cost, yeah, you're right. This is, I think, one of the other misconceptions, is that you hear this a lot. Well, it's guaranteed, right? It's not guaranteed. This is Mother Nature. Um, but if we look at the data historically, you're going to benefit more from the program. You're going to get more out of it than you put into it. And so, just based on the data and based on the strategies that we try to implement for the farmers and ranchers. So, um, but there are costs associated with it or potential, right? So we want to make sure that the farmer, the rancher doesn't think it's guaranteed. It is insurance. Um, if there's lack of rainfall for your operation, then hopefully we've set it up right to where you're going to trigger an indemnity so that you can continue on. Because insurance, I mean, insurance on the P&C, property and casualty side, right? It's to make you whole, to make you, whole again, right? So you can continue on. You don't have to worry about what am I going to do? How am I going to pay for that? And same thing here. It's to make you, to supplement some of those losses. So if you're concerned about premium, our recommendations are maybe we drop the productivity factor, but we stay at the 90% coverage level because you are more likely to trigger a loss there. Okay. We can drop the productivity factor or decrease your acres because you don't have to insure all your acres. And so we talked about, grids, and some operations are very, very large where they have multiple grids. And so, and you said it, you hit it right on the nose, 1 mile this way versus 1 mile this way in different terrains, it could change everything. So um, the rains might be different and whatnot. So um, you might not want to insure this area and you might want to just focus on this area. So you don't have to insure all your acres. So I think there are some different strategies that we can incorporate to help you save some premium dollars. But it's important to know that, when you set up the policy, when you sign that application, that premium that is on that application is what you are obligated to pay if you have to pay it. And so one of the other things that we haven't mentioned is the AD 1026 form. That's an FSA document, Farm Service Agency document. We mentioned subsidy, right? Well, the government is going to pay a portion of your premium, but you have to submit your AD 1026 to your local FSA office. Without that AD 1026 it's basically conservation compliance, right? That you aren't going to be farming on wetlands and whatnot. So once that AD 1026 is on file with your local FSA office, they will send that information to the AIPs, approved insurance providers. They'll have that on file. That will get you your subsidy. And so you don't have to submit that right away, although we want you to, because we don't want you to you're so busy. You got all kinds of things going on. And so we want you to get that in so you don't have to worry about it, because come premium billing time, if they don't have that, well, you're going to be on the hook for the full premium, the full gross written premium. And we don't want that. We want you to take advantage of the benefits that you have as an American farmer, and that's including the subsidy. So different strategies involved, productivity factor, and you don't have to insure all your acres. And so it's looking at the data, looking at your land, what makes sense. And, I think there's a lot of things that we can do to help with that, including beginning farmer rancher benefits, right? That's an additional 10% subsidy. So if you were at the 90% coverage level, that is a 51% subsidy. So if you're a beginning farmer rancher and they just passed, or they're about to pass, that it was 5 years, now it's 10 years. So that can essentially put you at 61% subsidy. So the government would pay 61% of your premium. That's I don't know why you wouldn't want to participate in that. So all kinds of things that we can discuss to help you with kind of manage that budget and those goals that you have.
Now, kind of the last question that we tend to ask, experts such as yourself on your program, it's what's a very key or the number one thing you want people to understand about PRF, particularly somebody that's looking to buy it for the first time?
I think the main thing is looking at the data, right? It has to make sense to you. I think if it doesn't make sense, even if I'm going to buy something, right, it has to make sense, right? If it doesn't make sense, I'm not going to have full buy-in. So I think talking with your insurance agent, having them break it down is super important so that it makes sense to you. The other piece to that is there are a lot of other ranchers out there, farmers, beekeepers that have this, right? You can ask around, ask them, how does it work? Has it worked for you? How did you structure it? I think so. In my former career, right, I was advising and education. I think our job, and you do such a great job of it, Mike, and I'm not just blowing smoke because you have me on your show, but if you go back to all of your podcasts, and I haven't listened to all of them, but I've listened to a few. You're very good at just breaking things down, and that's our job, is to break them down so that the farmers and ranchers know that what they're getting into, right? Because I think there have been a lot of things said about this program, like it is guaranteed payment, it's drought insurance, and those are wrong. It's not. Or we'll pay your premium. There's a lot of things about rebating, right? So it's important that we break these things down so the farmer and rancher or beekeeper understands. Um, eh, the key for me again is just ask questions. Continue to ask questions. Look at the data. You can go onto RMA's website and pull up the PRF tool to look at that data, but it's hard to understand. So talking to somebody who understands it to break it down for you is super important. And we joke about it, and I say we, I mean, I mentioned Tyson Baker, and so there are some times where we'll look at the loss ratios and it did pay out 10 out of 10 years or 9 out of 10 years. And so we'll say, well, we're going to go get you in a headlock and make you sign up for this because, you are going to benefit from this program. You're going to get more out of it than you will put into it. And so we want to help you. We want to help you to continue on because you are feeding our country, right? Or maybe you're just feeding your family or your community, but or our country, or maybe some people are shipping their stuff all over the world. So it's important, and things aren't getting cheaper, and so this is a way to help offset some of those costs. And I think growth, right? A lot of farmers want to grow, and sometimes they don't have the money, the capital, and this could help with that. And I think education is the key. Educating our farmers and ranchers on these programs is our job, and that's what we want to do. So ask questions on how it works. But you're going to get more of the program than you put in, and that's based on data. We can prove that over and over.
That's our episode today on Pasture Rangeland Forage, or PRF. I cannot thank Jaime Cortes enough for being a guest, a colleague, and a friend and coming on this episode. We appreciate your expertise, and thank you so much for your time. From my family to yours, thank you for tuning in. If you found this helpful, please subscribe and share with a neighbor. Visit www.cropinsurancepodcast.com for more episodes, articles, and tools. For full policy details, always check the crop insurance provisions or speak with your local crop insurance agent. This institution is an equal opportunity provider and employer.